across platforms, so we don't have a kind of pseudonymous user. We know that, say, for example, Crowdcubes say that an average investor is going to 12 different deals, but we don't know. Each of the platforms will know, because they may well ask us, as part of the sign-up process, do you use other equity-based crowdfunding platforms? But outside of the platforms, we don't know how many people are going across and diversifying that way. And I think that sort of information would be really interesting to start seeing that feed through. And in addition to that, I suppose the wisdom of the crowd stuff. How many people use, for example, there are platforms that specialise in IP. There are platforms that specialise in shipping and aviation contracts, and those are used by people within those industries who know that they can get an excellent return, 12-15%. The debt-based platforms, but how many people out on the street know about those platforms yet? Probably not that many. So I think what we can look forward to is a time when information isn't just shared among people on a given raise, just asking questions at the bottom, but actually, we can have sort of umbrella sharing of information.
Okay, let's move on now. Let's sort of head towards debt again. So I think both Angus from Archover and Nicola have talked about the institutions and their growing role. And one thing that interests me is are we already sort of seeing the end of the golden age of crowdfunding for individuals? We've had keen individuals in their spare bedrooms, doing their lending. Now the institutions are coming in and wanting to lend millions, hundreds of millions, whatever it may be. What does that mean for private investors? Angus, you clearly got a view from that.
Absolutely, I have a view on that. I mean, we've never allowed any individual or institution to take 100% of the loan on our platform. The most we've ever allowed any one person to take is 50%.
And will you stick to that?
And we will stick to that. Obviously, that might mean that you end up with only two lenders on the platform. I don't think we're anywhere close to the situation we have in the US, where they're actually holding the institutional money back. But if we did get to that stage, we would hold that money back.
Can you just explain a bit more what you mean by that?
Well, what was happening in the US is that some of the funds were actually building, where they were monitoring the projects that were coming up on the platform and taking the best ones straight away. So they flashed onto the platform the price of it, and the institutions put their money in. The individuals didn't have a chance, so they put some speed bumps in the way to stop the institutions doing that. Now, certainly we haven't reached the stage where institutions are coming in that quickly. Yes, we do have some institutional lenders who we pledge on their behalf as soon as a project goes onto the platform, and that gets us started. I think the individuals can take some comfort from that as well, because you do then have a more sophisticated lender coming in and saying, yes, this is something that I want to do, so perhaps you can take some comfort from that as an individual. But our ethos is still very much that everybody is a part of the crowd, everybody will remain a part of the crowd, everybody will lend on the same terms, and that will continue. That's how we started off.
I'll cut you in a minute, just Nicola, can you?
Yeah, well, we've taken the same stance. Similarly, we've never had anybody take more than 50% of the loan, and we want to try and keep the crowd motivated to participate. And I see the future of our business as being similar to when I've run fund management businesses, that I want a small investor. Remember, we're going to have ISAs soon as well, so we've got to deal with all of that. I want to have the high net worth individual. We have something called our managed portfolio service for high net worth individuals, and they have to invest a minimum of 100,000 through that service. And then I want the institutions as well, but I don't want to be too dependent on any of them. But I think the truth is that we're going to end up with a lot of institutional money. It's all trying to find yield, as are individuals, but in quite an aggressive way. I see institutions wanting to come onto these platforms, and it's a question of finding enough good quality loans.
But does that mean I won't be able to get a 9% yield on your platform in 2 years' time, because there'll be all this institutional money offering?
I don't think it'll necessarily bring down the interest rates. It'll just supplant the high net worths who've got the whole thing going, as being the biggest segment of lending.
Mad, what's your question?
Well, it's pretty much what Nicola just ended on. How do you regulate that? Would it have to be a policy to ensure? Because it's great that Angus and this company have the type of ethos to make sure that you have maximum 50%, but I don't know if every lender will have the same ethos or the same behavior. And would it take a policy from government or from business in general to all agree that there's a standard that they have to maintain?
I think the last thing we want is policy from government.
Need a canon of ethics.
No, but the FCA
Yeah.
already has this concept of treating all customers fairly. And so there's the question of whether one investor should be able to build an API, look into your loan pipeline and just pull things out and cherry pick. And I would think that once the FCA gets its mind around this, they're probably not going to like that.
I think I would go slightly further and say we absolutely hate it.
So, yeah.
Don't you think, I mean, because I'm old, right, I was trading in the 80s when, flotations were given. Nobody knew whether actually BT was going to suck all the liquidity out of the market. But one of the things that's going to happen, if you create a secondary market in this paper, in other words, I'm a guy that buys in. I want to trade my loan, in 6-8 weeks. Are you likely to go the way of, within 12 months of every single major flotation that the government undertook, less than, I think it was 7% of the stock that was issued to small investors was now institutionally owned on the basis that they all were trained to go short-termism and stag the issue. And once you create a secondary market, aren't you likely to end up with those loans being wholly owned by, like you said earlier, if you've got a 2-3 year loan, by the time you close that book, how many of your original loan owners will actually be the guys that are still on the books at that point? And does that mean then that you'll need institutions to come and mop up the...
Just go to you, Sonny, yeah.
I think partly up to your point is one of the attractions of retail, I'm sure Nicola would echo this in a second, is that and all of us, to the extent that we can be bothered to go online and make a decision to invest in money, we then leave it there because it's 3 years at 9.1%. And we're not revaluing our portfolio every day and seeing what else is out there and noting that the secondary market on Archover is at 9.2, and therefore we're going to sell out of our money in co-position into Archover. We as individuals don't do that.
How sticky your investors, Angus?
That's absolutely right, Robert. I mean, when we first had the arrangement with Asset Match that we've got, we went round a few lenders and said, would you seed this for us, get it going, put some loans up onto the Asset Match platform and sell them. And I think we went to 5 people, and 4.5 of them said no. We're not interested. We made our decision.
So would you say that's a fundamental change in investment attitudes since the mid-80s?
I don't know. I think it's perhaps. I too remember the mid-80s, but I think it's more about what we're selling to people. What we're saying to people is, you're committing here for 24 months, or whatever it is. That's the commitment, and 90%. That's what's going to happen. You're going to be in this for 24 months, and then you get your money back. Oh, and by the way, there is this: if things, your circumstances change, you will. There is this Asset Match platform, but it's almost a matter of last resort for them.
Currently, but what I'm saying is, one of the things that happens in any market, as you all know, is once a lot of money comes in, it gets efficient. That's the first thing. And secondly is, the emphasis may change philosophically for people from, I want that yield, but I want to mark to market. And there is a grey market out there, which means I will actually be able to trade
Funding
it.
Circle's the largest in the debt space.
Sorry?
And Funding Circle is the largest, and they're experiencing a churn of 17% per annum.
Oh, that's good.
So that people are selling their loans, and we're seeing a bit of it. And what we're seeing is people coming in at the end of an auction, putting a relatively high bid in, and if they then succeed, putting some of that loan or all of it up for sale in our loan market, and at a higher price, in other words, at a reduced yield, in order to make a quick turn.
Yeah.
So there are some more sophisticated day trader types, I think, who are going around these platforms and trying to come in at the end of auctions and trying to get a particularly favourable rate and then trade that position.
That's
As far as I'm concerned, that's good.
Currently,
That's
what
fine.
I'm saying is it likely to change with the size of the pool of capital will go up. And
Yes.
once more cash comes in, you guys know,
No, I think
the market
funding,
gets
funding
efficient.
circle.
It also gets more sophisticated and more liquid.
Yeah, I think you're right, because funding circle is much bigger, so
Yeah.
there's a much larger volume of loans, and there is churn going on. So I think you're right, as we get bigger, we'll probably
So in
see
5
more churn.
years, you may well have a complete, people's reasonably going in may well be the secondary market, rather than I want to hold a yield for 2 years or 3 years. It's not
I
inconsistent.
think a lot of people, there are a lot of private investors who hold gilts to the end, to
Yeah.
maturity. My mother does, you know, and
Sure.
she could have been selling them in the 80s and she didn't. She just hung on, and people want yield. Anyway, we could probably debate this all afternoon. Another one, so we've also, I think we touched on the whole issue of a couple of the IPOs that have been in the US of crowdfunding businesses, Lending Club in particular. I think its share price is around half its IPO price. Is this going to tarnish the industry? Is there a question of investment banks sort of, you know, pumping and dumping, and will this be a longer term problem? I don't know whether anyone wants to comment on that, or you don't think it's really an issue you're worried about? No?
It's certainly not an issue that keeps me awake at night.
Fair enough. Well, maybe we'll move on then from that one. And thanks, Martin, for that suggestion.
It actually does keep me awake.
Well, tell us why, Martin. Tell us
So
why.
this is shades of what happened in the first technology bubble. Can I just first off say that I think that what we're doing, with Nicola and Angus and the P2P folk in general, the ones who are wearing genuinely white hats. I'm not sure what the political analysis of it is, whether it's sort of red conservatism or sort of blue collectivism or whatever it is, but we are effectively credit unions, but instead of being a little old bloke with a ledger and a stubby pencil, we have a state-of-the-art 21st century administrative platform. And we are actually filling that, the funding gap exists and we are filling it, and that's a good thing. And that business isn't just doing stuff that can be analysed in terms of data, it's actually changing people's attitudes to finance. It's changing the borrowers' attitudes and feel more responsible. They shouldn't, but they do, I think. And it's also, because Mrs. Smithson of Warrington has put £5 in, and it's also changing the attitude and the ability, the readiness to be aware of lenders. And I think that means that those questions, we heard James talking about on the equity side, how the questions never go away. I think it was James, but on an equity raise, there's an intelligent awareness on the part of whether you call them investors or lenders in our case. And I think so. Let me just say that that's the case for this being a good, however one defines it in economic and moral terms. That said, if Lending Club is overpriced, and the market deems it to be so now, clearly, and despite having gone to an 80% premium when it floated in December, it went from 5 to 8 and a bit, nearly 9 billion. Then there's a real problem, not because there's anything wrong with what we're doing, or we're not meeting a need. The business model is solid, but if it's too aggressively overvalued, then people will run away from it. And so my only concern is that the investment bankers, I don't hate to point fingers, but actually the investment bankers will really badly agree. That's what keeps me awake.
Roger, you want to say?
Yeah, just a quick point. I think something that Nicola said earlier, that when investors look at these companies, they're undecided as to whether they're a technology company or a credit company or a banking company, pseudo-bank. And if it's technology, then it's given perhaps a silly valuation for reasons that others have alluded to, so long as you avoid making a profit. If it's a credit company or a bank, I think that there's too many people who still think that financial institutions generate ROEs in the 20s, which they used to. What the bankers will tell you today is that at best they're going to give utility-like returns and generate ROEs of 8%. And I think that when this all settles down, we'll realise that Lending Club is more of a utility than a tech company, and therefore 8% is probably better ROE. That may take a few more years, but I'm sure that over time we'll realise financial services, the days of 25%